Thank you very much all for joining me in this webinar, where today we're going to talk about debt structuring and risk assessment in real estate finance. And it's very important, especially these days when we talk about different ways that the world is going with tariffs, interest rates, hikes, inflation, and so on. So given the uncertainty, it's good to think about, where the risks are. And the good thing about structuring is in a financial modeling way, in a spreadsheet, is that we can really take a look at, like what are the pros and cons, well, more the risk around the whole discussion about risk that is going on. Okay, so my name is Maria Wiedner. I am the CEO and founder of Cambridge Finance, and also we do a lot of consultancy work and also a lot of training. And it's a pleasure to be here today to talk to you a little bit more about debt structuring and risk assessment in real estate finance. So let's move on. So the agenda for today, so this is a 30-minute webinar, and it's very quick, but the idea is to give you some overview of like how we are shaping our thinking around the different aspects of real estate finance, and also how our modeling is shaped in order to answer those questions, and also what we teach in our courses. So you can join us if you feel like these are things that you want to learn. So today we're going to talk about debt and equity financing strategies, pretty much the position of equity and debt, how we model loan repayment schedules from a financial modeling perspective, and then how we do stress testing, scenario management regarding interest rates and refinancing or repayment risk. So the idea is like on the exit, how are you going to exit this loan, okay, and the risks associated to it. Right, so we're going to start here with the idea of the split, the capital stack optimization between equity and debt. And then what we have is that we have the senior debt as the first tranche that we say in terms of seniority. So typically around 50 to 65%. And then after that tends to come an equity position. Okay. The only thing is that in the middle here, because we have had this idea of finance gap, then we have mezzanine finance, and the mezzanine finance tends to be around junior debt. So the subordinated debt, okay, junior debt, and we still call it mezzanine, but with the technical term is junior subordinated debt. And then we also have preferred equity, and then the preferred equity is further up on the capital stack. So when we are optimizing the capital stack, the idea is that you would get as much debt as you could, for example, and then the rest will be common equity. The only thing is that there has been a shift between like having less senior debt, and we have here more and more the mezzanine finance debt being taken into consideration. Okay, so when we are talking about capital stack optimization, the questions we need to answer is pretty much on the cost of debt. So for example, if you have cost of debt meaning your interest rate or and your fees and your mainly your fees and any repayment schedule. So what is your cost of debt? This needs to be lower than your asset return. And we're going to show you this in terms of what it means, like what is the ungeared asset return. So if you have your interest rates, you're all in, including fees and everything, say 5%, and your asset return is 10%, then this will enhance your return. So then it means that leveraging it, gearing, borrowing money will enhance returns. But we also have to be very careful, because the other way, the other side is also true. Because if you have, like, especially now that we see interest rates hiking a lot, increasing, then it means that if your cost of debt increases and your asset return does not increase, and in fact it decreases, then what happens is going to have like a negative effect on your return. So as much as the cost of debt, the lower cost of debt will enhance your returns, the opposite is true as well, that the higher interest rates, then you're going to exacerbate your negative returns as well. Okay, so it's always a balance between the risk and return, which is the point number 3 here. And then the idea is, we want to enhance returns, and we also want to comply with the covenants, right? So we're going to borrow as much as you can, as long as we comply with the thresholds that we have to comply, which are like the interest rate coverage ratio, the debt service coverage ratio, and so on. So it's always is a matter like the optimal debt to equity ratio is the one that balances the risk and return. Okay, and we're gonna look at it as well. So here is just a table pretty much showing like the typical scenarios, what we need to look out for when we are raising debt and equity, right? So what we can see here is that the higher the LTV, the loan to value band, the higher is going to be the interest rate, okay? And then the beginning here, like the lower end of the loan to value is a senior debt, and then the higher you go into the loan to value, the capital stack, then it becomes more like a subordinated and preferred equity scenario, okay? What we also have is, like, in terms of structuring the debt, we also see like the whole loans or stretch senior, and then this stretch senior is also like a senior and a junior kind of like packaged together. But when the lender is going to give you this offer on the stretch senior, they will have to internally split the part that is senior and the part of junior. But what we see is just one lender with just one blended rate as such, okay? But it's still like there is this structuring going on. And then what we have here is the typical covenants. Okay, so this is pretty much like what's the very average. As you know, like an average is there is a lot of like this there is a big standard deviation in terms of what we see in the market, but this tends to be what we're seeing right now. So the higher the security that you need, so in terms of senior, the higher you're gonna need the covenant. So the debt service covered ratio, the income covered ratio as well, the interest covered ratio, and then also in terms of loan to value. Okay, so this is just to highlight, like the travel, the direction of travel in terms of loan to value, which is the riskiness, the interest rates, and the typical requirements for this kind of loans. Here is a chart that just to highlight again what is that, because when we are modeling, we tend to model, okay, so if we have a loan to value of 80% and interest rate of 5%, then what is going to be the return? But what we see in reality is that, like, the higher we go in terms of loan to value, we'll still have to face, of course, higher interest rates, because this will represent a higher risk to the lender. Okay. In terms of the decision framework here, we need to calculate the base return across multiple leverage scenarios. Okay, so this is how, in terms of optimizing the capital stack, determine the break-even debt cost at each leverage point. So it's one that we have, that we say, okay, your debt service coverage ratio is 1. If it's lower than 1, then you're not breaking even. You don't have enough income in order to pay back in order to service your debt. Okay, and then you need to assess this cash flow coverage and refinancing repayment risk across multiple market scenarios. So the idea is that we need to test the repayment, how we're going to repay, or how we're going to, if you are the lender, if you are a bank, for example, how are you going to recover the money that you lend? How are you going to see your money back? Okay, and this is always like a trade-off. Like, what is you should not see any breaches in covenants, but then like how much higher and how much lower this covenant should look like. And then it is a matter of, like the qualitative analysis as well in terms of the decision to lend or the decision to borrow as well. In terms of modeling the loan repayment schedule, the key components of a loan repayment schedule, which we're going to see in a minute in the model that I've done, is that we need to look at the principal interest rate allocation over time. So how, like how we're going to pay back the principal, the amortization, and then the interest payments as well, like, because there are different ways to structure this principal repayment, different amortization schedule, and then also interest. So if it's going to be just like an interest only, if you're going to pay interest all the time, there's going to be a sweep, for example, or if it's going to be what we call PIK, which is the payment in kind, in that you're going to roll up your interest and then you're going to pay everything at the end. Effective interest rate. So this is also very important because sometimes we see different offers, and then some offers will say, okay, my interest rate is slightly lower. However, the fees are slightly higher. So you need to calculate, okay, in terms of effective interest rates, where I'm better off, where I'm paying the lowest interest rate, or if you are the borrower, or if you are the lender, what is my, if this effective interest rate is enough to pay back my capital, which, the lenders will have their own equity that they need to pay back. Amortization and balloon payment calculations. This is what I said, like what is the allocation of principal and interest allocation. So it's just repeating here, the amortization and the balloon payment. The balloon payment is the lump sum that we have to pay at the end. You need to be very careful here with this amortization rates, because I'm seeing more and more people using ChatGPT, Claude to create this amortization payments, and you have to be careful because property, it has a big residual value. So you need to make sure that if you are using the ChatGPT, that you understand this debt repayment, because otherwise ChatGPT is just going to give you a fully amortizing loan without balloon payment. So you need to make sure that you understand how the debt is structured, how it is, how you're paying back in order to model this better. Covenant calculations and red flags for default risk as well. So this is also things that you need to model. Like, so what is the covenants? Like, what is your ICRs, your DSCRs, your loan to values, LTVs, and if you have any red flags for default risk. So when we are building models, the idea is to build dynamic models, so then we can see like what's the difference paybacks or payouts in terms of interest rates, how we're going to pay back this interest, how much is the total amount of interest we're going to pay, variable amortization schedule as well. So if, for example, if you are amortizing the loan, even if it is a loan, for example, for 10 years, you can have different amortization schedule for 15, 20, 30 years, right? Because the idea is that we're going to have a balloon payment at the end. Future refinancing scenarios are different LTV and interest rates. So this is one thing that we need to look as well, like at the exit, are you going to pay back or are you trying to refinance? Okay, so then we have to, this is the work that we do, like, okay, let's analyze what we think the world could look like, the scenario management or scenario analysis in terms of what is that might be the risks at the exit. Is the exit through refinance? Is the exit through a sale? So then we pay back the loan. So how are we going to analyze this and say, okay, well, we are comfortable with the risk or we are not. And then the partial pay downs at trigger points as well. So it's mainly like if you are either a bridge or if you have, for example, cash traps, or if you have cash reserves, then it might be that you have to it might be that you can get part of your cash back, or it might be that you have to put some down payments for extra equity, for example, if you breach LTV, or if you breach any other covenants, or if you breach loan to value covenants, and so on and so forth. So you can also look at those trigger points and have a view of, like, what is the probability, what is the risk of this actually happening. Right. And then we can, when we are building these models, then it's very important to analyze the interest, the covenants, which is like what is gonna be the constraint for your for the amount that we can borrow, and how we're gonna optimize the capital structure. So we can need to look at ICR, interest coverage ratio, debt service coverage ratio, DSCR, debt yield ratio, total interest and fees paid over the long term, and principal reduction as percentage of the initial balance and property value. So that's pretty much saying what is the amortization profile. And then also we need to remember to model fixed and floating rate options with appropriate hedging costs if necessary. Okay, I don't calculate it specifically, explicitly the hedging costs, but this is something that it's always very difficult to model, but like there are some great companies out there, Chatham Financial, for example, that will look at the hedging costs, and then okay, so what will be this hedging cost for you to go floating and fix. Stress testing interest rates and refinance repayment risk. So we're going to look at here at stress test scenarios. So pretty much looking at what will be a base case, moderate stress, severe stress, and historical worst case. The way I model, we're going to show you, is pretty much on a parallel shift. Okay, so I'm just going to add the 100 basis points, the 300 basis points across the yield curve. Okay, and this yield curve is using the forward curve, which is based on our projections of the SONIA, in this case, the SONIA rate. Refinance risk assessment. So this is one thing that we need to look at. So it's like what it will be. We think is going to be the property value, the available loan to value, refinancing date, DSCR requirements and their higher rates, potential equity injection requirements. This is very important, especially in terms of CapEx, for example, not only about breaching covenants, but also like maintaining the value of the building. Okay, so if there is any equity injections there, we need to take into consideration, and then resulting IR impact across those different scenarios. Okay, hedging strategies as well. So we need to consider risk mitigation approach. So interest rate caps and the cost. Again, we mentioned the Chatham Financials, which will can look at those. You can look at those. Forward rate locks for future funding as well. Blended fixed rating structures, extension options, and associated fees. So there's also like hedging strategies if you think hedging is the best approach, or if you think I think interest rates were just going to go down, so I'm happy to not hedge it or anything. Okay, but you need to do this trade-off. And then we have here, when we go through the courses, we build a financial model, and then this is what I want to show you now as well, how to use or how to build these financial models to look at dynamic repayment schedules, calculation of the covenants, and look at the red flags, and then scenario analysis and planning. So looking at those scenarios there, what is going to be like your optimal capital stack, what kind of risk you're going to take, and so on and so forth. Okay, so without further ado, let's look at our financial model, so then we can take a look at the decisions we can make regarding this this property. So in this case, like, we have an asset, a model, so that's pretty much like the asset, the cash flow from a building. Okay, and then I am in the UK. Well, I am not now in the UK, but like I practice a lot in the UK. So then we have what we call like the open market value asset value rents hike. So then it's like fixed and then it shifts to market value after a certain period of time, normally between 3 to 5 years. Okay. So we first need to understand what is the underlying asset, the risks of the underlying asset. Okay. And then here we can come up with what is the asset NOI and the net cash flow here, including those the capital expenditures, any capex, any the purchase price, and also very importantly the exit value here, because we need to understand what is going to this amount here is what we're going to use to pay back the loan, okay, or that's the equity here that you need to refinance. Okay, so these are the main areas here of this asset tab. And then another thing is with this asset, and it calculates the ungeared IRR. So that's the asset IRR. So without any debt, without any financial engineering, what is going to be the IRR return? Because remember, one of the decisions about borrowing or not borrowing, or how much to borrow, is the idea of the cost of debt. So if you have an IRR, ungeared IRR of around 8%, and your cost of debt is 8%, so gearing would not make much sense because you're increasing the risk without really enhancing any returns, okay? So that's why a lot of, like, when interest rates go up, a lot of people say like, well, I'm not going to borrow anything. I'm not going to buy anything because it doesn't make sense. Okay. So if you have an IR of 8%, it will only make sense to borrow if this cost of debt, including the fees as well, is less than 8%. That's what we call the enhancing returns. Okay. And you have to balance the trade-off between this IRR 8% and your cost of debt with your increased returns, your increased risks based on the injection of debt into this ecosystem of investment. Right. So here, what I normally do is say, okay, so when we talk about the structuring of the debt, okay, so it's just like, so we need to look at what is going to be the principal and interest allocation over time. So if you want to find out what is the principal allocation all the time, I need to find out, okay, so what kind of types of debts there. So that we model here the interest only, constant amortization, and the constant amortization with a balloon payment, which is like the amortization for 30 years, but you're gonna pay here over 10 years. Okay, so you need to have this flexibility of changing. Then the one thing here is that it's very important is to build the fixed and floating. So here, if you have a fixed rate, then this becomes an all-in, a swap rate, fixed rate, okay? Or if you want to have the floating rate, then it's going to be a forward curve, okay? So we pick up the forward curve from Chatham Financials, for example, and then we plot in and say, okay, given the forward curve, the 3-month SONIA, and a margin of 1%, what's going to be my interest costs? Okay, so that's one thing that we model here, is that what is my effective interest rates and what is my cost of debt here. So in this case, you will have to pay 78 million in terms of cost of debt. So for a 10-year and a borrowing of 100 million, right? So you have to pay like 78 million, and your interest rate is going to be your effective interest rate over the lifetime if the interest rate, if the fixed, if the forward curve pans out exactly as we're projecting today, then your overall cost of your interest rate, your effective interest rate, is going to be 7.38. Okay, but then if you have, for example, a fixed interest rate of just 5%, then if you have like an interest only, then it means that your your effective interest rate in here will be 78 million instead of 77 million instead of 78. And then your effective interest rate is going to be 7.33. So they like when you start your margin and your fixed interest rate, they're kind of like they match because like that's how you calculate the fixed interest rate, the swap rate. Okay, so this is the one feature of a modeling real estate that is important for you to understand. And then the other thing that is important for you to understand is how much you want to borrow, right? Because it's very important for you to know how much you want to borrow and how much you can borrow. So if you think here about a loan to value of 90%, right? And then this is great. I would love to borrow 90%, especially if your interest rate is 5% and your expected IRR is 8%. So that will be, a scenario that as a borrower, you'd say, okay, that's I'm okay with this risk and this return. But normally it's not always like this. So when we're optimizing the capital stack, it's also important to know, okay, how much can you borrow? And how much you can borrow will depend on this covenants here, on what is going to be the threshold. So if you remember from this chart here, that the lenders are going to give thresholds for you, say, okay, you cannot breach the 1.35, 1.30, and so on and so forth, then this needs to be reflected in your financial model as well. And as you see here, right, we are saying, okay, we have a borrowing cost of, we have the threshold here is 135 if you're just like interest only, but then your minimum ICR here is 0.88. So actually you're not even having the break even point for the to pay back the debt service. And if you have to amortize, then things start to get even worse. Okay, so how would you, so here what we normally do is that you say, okay, so if you take into consideration, so it's going to be like a constant payment with a balloon, okay, and then you think you want 90%, but given the thresholds, you can't really have you can't really have the 90%. So what you need to do here is you need to find out what will be the maximum you could borrow. So you can try here. So say, if you say like, okay, what happens if I borrow here at 50% loan to value? So what's going to happen? You're going to have oh, there's something weird going on here. But for example, if you're going to borrow here 50% and then your maximum ICR is going to be 1.5, and then your DSCR, normally your DSCR should be lower. So you're going to have here your DSCR and your ICR, and then you're going to say, okay, if it's 50%, then it means that you're not going to have this is going to be your covenants, right? So in that case, you're going to say, okay, I cannot borrow the whole thing because I'm breaching the covenants. Therefore, what we need to find out is how are we going to find out how much you could borrow. So in this case here, what we can do, for example, is just say, okay, I'm going to run here a goal seek, for example, a what if analysis goal seek. And then you're just going to say, okay, I'm just going to set the cell here. To 1.5%. By changing my loan to value. So then you can see here that you'll be able to calculate the amount of money that you could borrow, right? So 52%. So then you don't breach your covenants here, the 1.5%. Okay. So if it is 1.5%, so if it is 1.35%, then you can change that as well and find out. So you could borrow a little bit more here if you change the maximum loan to value. Okay. So the idea here of your capital stack optimization is trying to find what is the maximum you could borrow given the thresholds that you have in terms of covenant. Another thing that is important here, so the optimization of the capital stack is pretty much based on the covenants and your interest rates. Okay. Another thing that is very important here is the comparison between your ungeared IRR and your cost of debt. So in this case here, your ungeared IRR is 7.93%, but then your effective cost of interest, effective cost of debt is lower than that. So what's going to happen is that this is going to be like an enhancing return scenario. Whereas if you have, for example, a lower ungeared IRR and your cost of debt is higher, then that means that you're going to have like IRR that is going to be less than what you started with without borrowing. Okay, so it's going to be even much lesser than you started with. So that's when you say that borrowing is not accretive, but it's decretive because it's going to be diluting your IRR. Okay, and then here you can calculate your cost of debt as well in terms of your total cost of debt. So we mentioned that you're gonna have like how much you're gonna borrow, and then how much is gonna be your interest rate. So in the beginning here, where we had like a 90% loan to value, we had like around 78 million interest costs, but now here we have like 45 because we need to reduce your interest costs. Another interesting thing here, I'm just going to finish in 1 minute, is that you need to calculate what is going to be this stress scenario. So what is going to be your ICR, for example, your DSCR, and your geared IRR, given the different scenarios. So this is the loan to value, and then what happens here if you have different interest rates. So what happens if your interest rate is 4%, 5%, 6%, and 7%? What's going to be your debt service covered ratio and your geared IRR. Okay, so if you have here, for example, a scenario of 7% interest rate and an 80% loan to value, that means that you're not servicing your debt, you are in breach, and then your IRR, your geared IRR is going to be a lot lower than your ungeared IRR, which is started around 8%, 8%. Another thing here is in terms of this active scenario. Oh, now I know why that was the problem, because when we have here the active scenario here, when we're doing the scenario analysis here, we can also stress here, like, okay, what is my base case? What is going to be my moderate 3, for example, 4 and 5, the worst case scenarios. And then you can calculate, okay, what do you think is going to be your exit rate or your exit value or refinance value at the point of exit? What's going to be your loan to value? So in this case, your loan to value at exit is going to be 33%. So remember, it started like at 52%. So you're going to reduce because there is a balloon, but because there is like an amortization schedule there. And then the total debt cost as well. And then your effective interest rates. So there is like also another way for you to look at what is the optimal capital stack for you, given what is your cost of debt, your effective interest rates, and also the probability here that you're not going to be able to pay back. So it's mainly looking at the exit or refinance value here in relation to your loan to value and say, okay, 87%. So so only if the market drops by 50% that I'm not able to pay back the loan, for example, in this kind of like bad scenario. So that's like those kind of trade-offs that you need to start making in order to say, okay, I'm comfortable with a 50% loan to value or 60% and so on and so forth. Okay, so I am overrunning here. So the only thing I'd like to mention here is that if you like what you've seen and you want to learn more, please join our courses. We're going to have a course on AI, on artificial intelligence, on the 29th and 30th of April. It's going to be online, okay? And then you're going to learn a lot of different tools, like even like VBA, Python, and JavaScript. Like it's all known code, but how you use a known code with JNI in order to make, for example, a financial model project and so on, okay? And then other than that, we have the more specific real estate debt structure and financial modeling, and that's going to be on 19th, 20th, and 22nd of May. If you book until the end of the week, then we can give you a 30% discount. And I hope you enjoyed it. As I mentioned, please come and join our courses. If you have specific questions, you would like to have some consulting, some advisory work done for you, then we are happy to help you with. And then please get in touch. And we hope we can help you with your career, with your business, with your decisions regarding property acquisition, disposal, construction, whatever you have in order to make, robust financial analysis. So thank you very much for joining me. And any questions, please let me know, and I'll be happy to answer those. Thank you.